Jeremy Siegel, he's also chief economist for WisdomTree. It's good to have you back, of course. I'm wondering what you make of what's been happening in the market. You see it from Oracle, you see it from Broadcom, and frankly, you see it from a lot of other stocks. This AI trade, at least for the moment, seems a little out of favor.
Yeah, and you know, when you sell for 30 times earnings or 40 times earnings, nothing can go wrong. And when a few of the narratives wobble, as they are, that puts that caution into them. By the way, I think those stocks are still up pretty healthily for the year, but for the first time in a while, you know, we've often talked about the rotation, you know, and then it disappears a few weeks later. This rotation I think, might have more legs than some of the ones that we've seen earlier this year.
Boy, it's interesting that you say that. Others are as well. You know, Wolf Research today, is the broadening finally happening? They would wonder that maybe it is. If you look at the sector winners that have taken to the forefront since the Fed decision, materials are up 4% and financials are up 3%, a record high today. Industrials up 2%, a record high today. Healthcare's done quite well. This certainly seems to be at least a trend change of some sort.
Well, you can't say for sure because there's been so many head fakes in the past. But as I said, this one has more legs in the sense that there are more things that are happening that throw doubt on how fast or how profitable all the AI build-out is going to be. And, you know, what's going on, Oracle, these delays, part of it is because expenses are going so high for building some of these data centers. And that, of course, adds to the burden of how do you get profitability out of them. On the other side, some people say, hey, you know, if they're delayed, maybe that will prevent an overbuilding of them. So you can see a little bit of maybe little silver lining there, but I think it adds more questions than answers in terms of the ultimate profitability of AI.
Yeah, what is your big takeaway from this Oracle story today, which has undoubtedly unnerved the market at least a little bit?
Well, I think it started, you know, when, you know, the big, all the capital expenditures that run into the hundreds of billions or trillions. You know, academics have been doing research on how well do firms ultimately do that have high amounts of capital expenditures. And Scott, the results are not good. I had a chapter in my book called Capital Pigs, in the sense that those that expend more relative to their income on capital overexpand and ultimately suffer poor returns and lower profits. Now, I'm not saying that that's necessarily going to happen to AI, or certainly all of the AI, but that narrative has to come in mind, and there is research on saying too much capital expenditures is going to be bad for your stock.
What do you make of the idea that Michael Hartnett of Bank of America puts forth today, that really what we're witnessing in the market may in fact be a relative trend change, that what was a K-shaped economy being, in his words, all the rage in 2025, now we're front-running what he suggests could be a run-it-hot economy in 26, and we are thus rotating into a lot of areas that would take advantage of that kind of trade. Are you a believer in that?
Well, I was actually quite encouraged by, you know, the Fed response. Jay Powell, he seemed more calm about inflation than I've seen in a long time, in terms of saying, yeah, most of the effective tariffs should be washed out. It's a one-time increase. He said indicators of inflationary expectation are more under control. Yes, it was a close decision, but you know, I was actually quite impressed by that. Now, there's two bumps that we have. We have the bump of the Supreme Court tariff announcement, and what is that going to be, and what is that going to make? And then, of course, as we know, we have another fiscal cliff at the end of January. And I think the betting markets actually say 30% that there's going to be another shutdown. No one wants that. I mean, that could have subtracted 2 percentage points from GDP in the fourth quarter, and it could even be worse if it happens. I think everyone wants to avoid it. But after that, if we can get past those two, there's the headwinds of the tax refunds, the tax bill, the effect of the tariffs of basically having gone through the system and digested better than people had thought, that actually marks a better 2026 than certainly I thought we might have, let's say, at the middle of this year.